Well, good morning, everyone. We have reached a great milestone in this course and this semester. We're down to our last chapter, chapter 13 on the analysis of financial statements. So basically, thus far we have looked at the preparer side of the financial statement. So you should have gained a pretty good understanding of, how numbers come to be, what's presented on the income statement and the balance sheet. And so for this chapter, what we're doing is kind of stepping away from this micro view of the financial statement into a macro view of financial statements and just assess the company's and management's performance. So these are the objectives that we'll be covering. There's some that we are going to reserve for another time, and I'll let you know when we come to that. So the first thing that we're going to do is sort of explain this analysis, the purpose of it, which is pretty much to evaluate, as I said, the company's performance. So this is helpful for creditors if they're going to lend money to the company. Is also helpful for management to see how are they performing, and of course for investors. And so basically we're looking at three aspects, kind of like a 360 performance evaluation. We're looking at past and current performance. We're looking at the current financial position, and we're looking at future, right? That's this, and number three is probably the most important because financial statements are based on historical data, and so we kind of need to extrapolate that information to project, to make future projections for future performance. And like I said, this is helpful for internal users and external users. So we have our 4 blocks of analysis. And we're gonna need of course, our annual report, the financial statements, the income statement, the balance sheet, the statement of stockholders' equity, the statement of cash flows, and the notes to the financial statements. So actually, our 360 performance evaluation is going to start to evaluate within the company. So we're going to look at within the company what has been past performance and current performance. And then, of course, that is only just one part of the analysis. We need to kind of compare with, competitors, the industry, and other guidelines. It's like you, for example, you receive a grade on an exam, and you might turn around and talk to your classmate and say, hey, what did you get on that exam? And so you kind of compare your performance on the exam with your peers. So in the same way is what we're doing with our company. So there are different tools of analysis. We have the horizontal and vertical analysis and ratio analysis. You're most familiar with ratio analysis, or some of the ratios that we have looked at throughout the semester. So the first thing is the horizontal analysis. So we're looking at data for the company across time, okay? And in order to calculate this horizontal analysis, it begins with analyzing the change, the dollar change from our base period to the analysis period. So for example, I want to analyze the change between 2019 and 2018. So 2019 will be the analysis period and 2018 will be the base period. And so in order, after that, we figured out the dollar change, then we're going to divide that by the base period amount and multiply by 100 to come out to a percentage, which will make more sense when we are analyzing these changes. So here we have an example of Apple company. We can see, and let me just get my handy pen here. There we go. Okay, we can see that for some reason we have a negative balance on our cash account. Cash account hasn't changed. We ended up it changed pretty much, but it changed very slightly compared with other accounts. Something that may call my attention might be the accounts, an increase on accounts receivable. So maybe we want to evaluate how we're granting credit, what is our accounts receivable turnover, what are our compared to days, how many days are these receivables outstanding. And the same analysis would probably need to be made for our inventory because it has more than double in the period. Excuse me. And so that is something that we also need to analyze with maybe ratios. Okay. Other things that we might be concerned are we have an increase in our security, so it looks like we're investing, and we're also purchasing property, plant, so we're expanding. And since our cash is sort of pretty stable from year to year, hasn't significantly increased to support these expansions, this will probably lead to an increase in our liabilities. And we can see here that we have this long-term debt that has increased. Basically, we have to finance this expansion somehow. And if we don't have the cash to do so, then it's going to come from debt, and it may also come from capital. Okay, so those are just a few items that we can analyze when looking at these percentage changes. And the same will go for the income statement. Okay, so exactly how was this 6.3 calculated? We have a difference of 13,595. Of course, this is in thousands, but 13,595. So this is the dollar change between our base year and the current year. And then we take this dollar change divided by the base year to arrive at the 6.3. And we can see here that our sales remain fairly increased by 6%, but our cost of sales seems to have increased at a higher rate. So that could be of a concern. Maybe we need to analyze our purchasing, our inventory, and this correlates with that big jump on inventory. So this is something that requires further analysis. And of course, you have to look at the industry. We're looking at a technology company, so of course there's gonna be a big amount of monies and capital going to research and development. And so in essence, we end up with an increase of our I'm sorry, I'm pointing at the wrong, an increase in our net income. Okay, and so we this is just 2 years. Usually a 5-year analysis of trends will be more significant, and that's what we're heading in a few minutes. Here we go, trend analysis. And so looking at trends, in order to calculate our trend percentage, we're going to take the analysis period divided by the base period and then multiply by 100. So again, if we're analyzing 2019 versus 2018, we take our 2019 amount, for example, cash, and then divide it by the 2018 cash balance, and then multiply that by 100, and we arrive our trend percentage. So here we have the figures, okay, the dollar amounts, and we have converted those into a trend analysis. So this 4th year here is the base period, and these are the analysis period, okay? And so how did I arrive at the 107.0%? Is I divided my analysis period by the base period and multiply it by 100. Okay, so that's the calculation. And then for the second year, I will take 233,715 and divide it by 170 and then multiply it by 100 and so on and so forth. So we're just all using the same base period in calculating the percentages. And once that we have compiled that information, then it'll be easier to analyze. Okay, so I can see that sales were increasing. Okay, something took place a year ago that my sales went down slightly, and then it looks like it's on the recovery stage in the current year. And the same thing with our costs. So they seem to be pretty much manageable. The one that's concerned is probably our operating expenses. So this is something that we need to check. So it may be related to the research and development expenses, but perhaps this is something we need to take a closer look. And of course, I know a graph it describes this relationship a lot better than just looking at numbers and percentages. So you can see that our operating expenses here, this line in green, is rising a lot, more than our net sales. In fact, our net sales seems to have been meeting our cost of sales line over here. Okay, in terms of vertical analysis, pretty much the same formula, the analysis amount divided by the base amount times 100. But our base amount, instead of being prior year, our base amount is going to be depending on what account I'm analyzing. So if I'm analyzing a balance sheet account, the base amount is going to be total assets. If I'm analyzing an income statement account, the base amount will be our revenues, okay? And that will give us a percentage per account in relationship to total assets for the balance sheet or sales for the income statement. Okay, so we can say, for example, that 51% of securities of all of our assets looks like the bulk is being invested in marketable securities. Okay, so more than 50% of our assets are going to marketable securities. Okay, so we can analyze the percentages. And we do the same thing with the income statement, except that we're comparing each account with sales. So cost of sales is 61.5% of sales. Gross profit is 38.5% of sales, and so on and so forth. The next part of our analysis includes ratio analysis, and you guys are familiar with liquidity ratios. So far we have looked at those throughout the chapters and throughout the semester, including our, well, I don't think we have looked at working capital, but working capital is just a quick calculation of, how much cash do we have, how much liquidity do we have in hand to kind of cover our liabilities. So we take our current assets less our current liabilities, and hopefully we have a positive amount. Our current ratio, as you know, is our current assets divided by our current liabilities. And when we say current, we mean 1 year or less. Okay, so current assets, we're going to derive a benefit within 1 year or less. That's current. So mostly property, plant, and equipment will not be part of our current assets. Most intangibles will not be part of our current assets, etc. And then current liabilities is the same, is 1 year or less. So this will include our unearned revenues and accounts payable and accrued liabilities, etc. And so we're basically saying, or it's preferably to get a current ratio of 1.0 and above. But we also have to compare with the industry. So depending on the industry, a current ratio of 1.0 might be preferable or it may not. Okay, so depending on that too. So the asset test ratio or quick ratio is just the same as the current ratio, except that we have made a change and we are excluding things like inventory, prepaid expenses from our ratio. Okay, so it's very, very liquid. Okay. Accounts receivable turnover. We looked at this, I believe, in chapter 7 as well. We take our net sales and we divide it by the average of accounts receivable. The average is calculated by adding the beginning and ending balances of accounts receivable divided by 2. And indicates how many times the company converts its receivable to cash. So I made a sale on credit, and so how long is gonna take me to collect the cash from that? So that will be one time that will complete the cycle. And so how many of those cycles do I have throughout the year? Our inventory turnover is the same concept as our accounts receivable. And so we're looking, instead the formula has changed. We're looking at cost of goods sold divided by our average inventory. So again, we're looking at the time that, how many times do we go through the process of purchasing the inventory and selling the inventory. Days sales uncollected, it indicates how many days our receivables have been outstanding. And as we know, theoretically, the longer a receivable is outstanding, the less likely we're going to get paid. And so knowing how many days that receivable is outstanding will help us, increase or have certain, discounts or incentives so that we can get cash quicker. Okay, and then our day sales in inventory, again, we're trying to find out how many days our inventory is on hand, okay? Because, the longer that we have our inventory, the longer that we run the risk that the inventory may become obsolete, it might be damaged, our costs increases because we have to, have a warehouse for the inventory, have security for the inventory, etc. Okay, so this is an important piece of information. Total asset turnover, we're looking at, how do we using our assets to generate sales. So, what kind of assets are we investing and how do those contribute to increase our net sales? And so we have this ratio to help us. We divide our net sales divided by average total assets to calculate that ratio. And so that will complete the liquidity ratios, and then we move on to solvency. So creditors might be interested not only just on liquidity, are you able to pay the debt? Do you have enough cash on hand to pay, make those monthly payments on your loan? But they're also looking at, what is, the amount of assets that you have versus other liabilities that you have. And so we don't want the company to become insolvent. Okay, and so we have these ratios to guide that. And I want to make a distinguishment between debt ratio and debt to equity ratio. So debt ratio is basically the ratio between our total liabilities compared to total liabilities and equity. Okay. And then we have the equity ratio, which is total equity divided by total liabilities and equity. So in this case, what we're saying is that 64% is financed by debt, and 35, almost 38% is financed with capital, with equity. Okay, so we need to make sure that we're not highly leveraged, that our operations are not run heavily with debt. So that's something that we need to keep an eye on it. We need to compare with previous years. Is this increasing, decreasing, and how does it compare with other companies in the industry? Our debt to equity ratio, we're looking at total liabilities divided by total equity. So if you remember, the debt ratio was total liabilities divided by total liabilities plus equity. Here we're looking at total liabilities divided only just by equity. Okay, and so again, we're looking at leverage. Okay. Another estimation of solvency is times interest earned. So basically we're looking at, how many times our ability to pay the interest on the debt. You have to think that there's a close relationship between debt on the balance sheet, right? And interest. So no one's going to give you money for free. Whoever the bank or any other is going to charge you interest, and that interest expense is going to affect your income statement. It's going to affect your bottom line. So we want to assess, the power or the ability to pay this interest. So we'll start with our book net income, and then we add interest expense and we add income taxes to arrive at this income before interest and taxes, and then we divide it by interest expense. Okay, the last one that we're looking at here is profitability. We only have three ratios. The first one being profit margin. That will be our net income divided by net sales. We're looking at return on assets. We're looking at net income divided by our total average assets. And then we're looking at return on common stockholders' equity. So that will be our net income less any preferred dividends divided by average common stockholders' equity. We're gonna put a pin on market prospects and come back to that later. You have a good summary of the ratios which you can use while you're preparing your assignments or completing the exam. Okay, this last part, it just shows a report for the analysis and the structure of that report. And we don't need to look at the appendix. So this will pretty much complete our presentation for chapter 13.